6 real estate buying hacks, poor mindset versus wealthy mindset. How the wealthy actually buy real estate, not the way most people are taught. The third hack is use leverage strategically. This is the poor mindset. I do not want that. Wealthy mindset, I want small, fixed long-term debt. It's all right to have debt. Smart debt is a wealth accelerator. No control equals no leverage strategy. So it's okay to have debt. This is, by the way, this is the how wealthy build and create wealth is by using leverage, by using other people's money. And then in this case, since we're talking about real estate, it's talking about taking the debt from the bank. Case study, this is a good one. I want to show you how this particular client bought leverage, not just the property. So that's how you underwrite, and this is how you can actually make money. So this is the deal. Is the purchase deal is 1.615 million, down payment 30%, 485,000. So he borrows from the bank 1.130. He has 18 units, 3 buildings. He has 4 vacant units, and the cost per unit is 89,733. So that's, by the way, another thing that we typically calculate whenever we analyze the deals. The cash flow, we also look at the cost per unit. So like in this particular case, 89,000 is like very cheap. And I know this property, I've been there. So it's all brick. It's amazing. For 89,000 to build 2-3 bedrooms today, it's no brainer. It's like a really good deal. So now the gross rent, if you look at like in this middle column, so he collects 198,000 a year. Expenses come out to 74,000. In net operating income, so the gross minus the expenses comes out to 124,000. So going in cap rate is 7.68%. So now see what I'm talking about. You know, like when he actually went in, going in cap rate was 7.68% with the value 1.6 million. And what actually came out after all the renovations. And this is how it's important, because he calculate, that's why this is a good deal, because going in, it means that what he purchased at the closing. So at the closing, he purchased the 16 units, 4 of them were vacant. So that's another thing important to calculate. Because another thing I actually wanted to mention with this prior deal with the 6 unit, you see like the way when I shared with you here, when we calculated this rent of 79,200, that's assuming that all 6 units will be paying. But now imagine if 1 unit is gonna stop paying or they're gonna move out. So like actually the income, the revenue will go down, and then your cash flow is gonna be even more negative. So that's why like here you see like when we calculate between 5 to 10% vacancy. So we assume that. So that was all prorated. And then when we calculated, so basically we calculated that these 4 units were completely vacant, there was no income. So now he purchases this, and then he does the renovations. So he rents out all the 4 units. Also, another thing, by the way, that I also wanted to mention is like when you're purchasing like this rental property, another way for you when you're purchasing like with the value add, another way to look at the lease that the tenants they're paying, like how much rent they're paying, what's the upside, like how much can you bump it more up, what can you do to bring it more up, and how long are they staying there. So again, like in this particular case, in that case, right, he has 6 tenants, and 4 of them actually, like 2 of them just moved in, and 4 of them, so he just purchased it in January, and 4 of them, they have a lease up until October 31st. So there is not much he can do. He can just pray that they're gonna all pay, 6 of them. He cannot even increase the rent because he cannot just vacate them. He has to wait up until October 31st for them to move out. So in this particular case, like I said, four units were completely empty. So like that was a quick turnaround. He did the renovations and then he got the people in there. In other units, they were, you see, first of all, like there's 18 of them. So they like the risk is already spread out. So many units, they were like literally moving out like a few months right after he purchased the deal. So once they moved out, he did the renovations right away, and then he increased the rent, and then he got new tenants. So he was able to do this whole thing in less than 6 months. Like in less than 6 months. Now look at the right column. The gross rent is 261,600 a year. Expenses is still the same, 74,000. So now the net operating income came out to 187,600. So you see, from 124,000 it went up to 187. So it's 63,000 more right now. So now this is how he increased his value. Now, if we take this cap rate of 7.68%, divide by 187 600 NOI, so basically the value of the property is 2.4 million. So you see, like, he increased the value of this property right now, and the equity is 829,000. Another thing is that besides just increasing the equity, so his cap rate is like 12.5% here. So it went from 7.68%. Now he's getting 12.5% in cash flow. That would be his cap rate. So and this is what we're talking about, like how to use the leverage and how to use the equity value. So now what he can do is he can actually, and that's exactly what he's doing right now. He's going to the bank right now to refinance and to pull the money out. So now you see, like, his value went up almost by 400,000. So now he can pull this money out, the money that he invested as a down payment, and with this money he's gonna go and buy another property. So, and that's how wealthy create wealth. So now imagine doing like 10 deals like that, and that's it, you can retire. And here's another beautiful thing, because the money that he's going to refinance, the completely tax-free, you don't need to pay taxes on that, and you don't need to sell property. Like, why would you want to sell property that is producing cash flow and producing very good cash flow? Hack number 4, tax savings are part of the return. So most people calculate returns as rent expenses. We calculate it as cash flow, depreciation, cost segregation, interest deductions, and tax bracket reduction. So with the tax savings, it's, that's another thing, one of the misconceptions and overlooked deductions in terms of the return on your investment. Many people always ask me when I talk about like return on your investment, 10-12%. But then when we start talking about like the real estate, the cap rates, and when I share the deals that I am in there where I'm investing like between 3 to 6% cap rate, everyone's like, oh, it's very little because like this guy over there gives me 20%. Yeah, 20%, this is like assumption, this is projection, maybe in the next like 2-3 years, and the risk is very high. Like with me, yes, like my cash flow between 3 to 6%, but at least it's very steady. I get it every month, every quarter. And plus, another thing is that I get this upside on the deductions, on the tax savings, because it's one of the fastest deduction. This is one of the fastest return on your investment, where you can get the money back right away without waiting for 2-3 years, and there's no risk. So like, just give you an example. So in this particular case, this doctor, he buys the property for $1.2 million. The income is 300,000, and he uses the cost segregation of 180,000. He is in the 40% tax bracket. So that's a tax saving of $72,000 a year. So now imagine it's $6,000 a month in extra cash flow. So that's another thing. Like, whenever you're calculating your return on your investment on the cash flow, like, keep in mind the taxes that you can actually save and all the deductions that you can have, because like that cash flow that you're receiving from the tax deductions, that added to that cash flow that you're receiving from the rental properties, and that should be calculated in the returns as well. Hack number 5: buy with the exit in mind. Retail buyers, poor mindset buyers, they'll figure it out later. That's how they're thinking. Strategic buyers ask before closing if you're gonna refinance, we're gonna sell, 1031 exchange, or pass to children. So it's very, very important. Whenever you purchase the property, always already think how you're gonna sell. Like, what would be the exit? Like, are you gonna be keeping? How long you're gonna be keeping? Are you gonna be selling? Are you gonna be selling and paying taxes? Are you gonna be doing 1031 exchange? Like, these are all very important things to think before you buy. Wealth path is the cash flow refinance, reuse capital, buy next asset. You do not buy building, you buy wealth PEP. Just like I shared with you, like with that example, you see, like this is an amazing property. Like he doesn't he need to even sell. He can just keep it and keep it forever. Keep collecting this cash flow, but then at the same time, he already pulled out the money, and then this money he can for free, by the way, tax free, without paying any taxes. Now he can use it and buy another property. And the last hack is do not buy alone, buy with the structure. So what I mean by that, the poor mindset buys personally, pays highest taxes, manages everything themselves, and they take all the risk. The strategic wealthy buyers, they use LLC, they use partners, and they separate ownership from the operations. So this is very important. So let's talk about buying under the company. So real example, last week, one of our new clients came to us. So he's a doctor, anesthesiologist. Like a very demanding profession, very important, and a very high risky. So he has his practice, and then at the same time, under this practice, being anesthesiologist, he has a property that is registered under that company. Two things wrong with that setup. Well, one of them is, God forbid, if he sues, even though he has a malpractice insurance, if he is being sued, then they can go after his asset, which is the real estate. And then at the same time, he has this real estate which he rents out. So if the tenant or someone will sue him under this real estate, they can actually go after the practice as an asset. So you never want to keep it under one company. And I see this very often. Some don't even open company, for a number of reasons. Some just try to save money because you have to pay for the therapy fee and then do another tax return. So you're trying to save all this money here. But I don't think it's a good idea to try to save money on that asset, especially real estate, because God forbid something happens, you don't want to lose that. So you always want to have under LLC. So typically the properties are under LLC, not a corporation. That's kind of another thing with this doctor, because that real estate he has under corporation. So you see, again, when I spoke about it, have an exit in mind. So when you purchase the property under corporation, and what it means, why would not it be a good idea? Because when you sell that real estate, and if it's under corporation, then you will have to be paying this double taxation. So that's another thing why it's important to have an exit in mind. Having other LLC, it gives you this extra layer of protection. So because you want to make sure that you protect all these assets. And another thing is also, if you're buying many real estate properties, have separate companies. Do not put all the properties under one LLC. It's a very common mistake too. I see business owners make. Again, they want to save money on legal fees, professional fees, setting up the businesses. So they're trying to have one company and then have all the properties under that property. No, you want to have under each property separate company. Using partners, so it's that's the fastest way for you to generate and buy this property. You don't have to do it all alone. You can partner up with someone, depending on how each of you can benefit from each other, what you can bring to the table. And also talking about partnership, talking about okay, even if you decide to buy yourself, but then you're trying to manage everything yourself, so then doesn't become an investment. It becomes a job for you. So these are some of the things to take a look at. So the real structure is that doctor, business owner, they bring capital, credit, strategy, and team brings management, execution, and a scale. You earn cash flow without becoming a landlord and having an extra job yourself. Cash flow first, keep this in mind, but then order matters. So basically, cash flow that gives you freedom, control, tax efficiency, leverage, and equity growth and scale. Most people start with how cheap can I buy versus that's why they start small, versus actually looking at all the criteria that I already shared with you. So, and lastly, common mistakes high income professionals make: waiting for the perfect deal, over focusing on interest rates, buying emotionally, loving the property, not the numbers. We already covered all of that. Waiting for the right time, treating a primary residence as a retirement, and paying off mortgage too fast. By the way, like on paying off mortgage too fast and treating the property as a retirement, I think I will need to do like a whole separate session on just on that. And I'll do that probably. So what to do instead? Align real estate with tax strategy. Use that strategically. Build system, not stress. And let assets work while you earn. And in conclusion, real estate isn't about houses, it's about positioning. The wealthy people do not ask how can I afford this. They ask how does the asset serve my long-term strategy. Real estate should lower your taxes, increase your net worth, create options, and buy you freedom, not stress.